You're listening to the Axis Real Estate Podcast, the official podcast of Axis Real Estate, your full-service real estate brokerage in Phoenix, Arizona. Hosted by Jason Sellers and Ted Work. Welcome back to the Axis Real Estate Podcast. I, as always, am Ted Work. With me, as always, is Jason Sellers, and we have an excellent guest today. Jason, why don't you reintroduce our guest?
Welcome, Zeno Zenarro. And remind us of your mortgage company that you're with right now.
C2 Financial.
C2 Financial. Zeno Zenarro from C2 Financial. Thanks for coming out. I've known Zeno. How long has it been now? Like
It's gotta
6, 8 years?
I think, yeah.
Something like that.
Better part of a decade.
We met at a golf networking group.
Shout out Golf and Grow.
Shout out to golf. Is it still Golf and Grow?
Somewhat.
So we're here today. So last episode, we kind of got a little bit of background information on Zeno and how we got into mortgages and in the real estate game. And now we're just going to kind of pick his brain about what's going on in the market today relative to mortgages. We'll probably go over some rates, how the NAR lawsuit's going to affect the loan process as it may affect the transactional side, and just kind of get his ideas of what the market's looking like today.
Awesome. Let's dive in.
Yeah. So let's get right into it. What are the rates doing right now?
Yeah. So as of last week, when the most recent CPI reading came in a little bit below expectations, we've seen rates start to come down a bit. You know, this is not a advertisement to lend or guaranteed to lend, but right now, for a lot of for our more qualified buyers, conventional rates are mid sixes, government rates are in the fives. So now we're in a very appealing place to.
And we haven't seen fives in.
We saw them very briefly at the end of January, and then the CPI reading came in a little hot in the beginning of February, and that spiked rates back to where they were before, like 7-8% ranges. And it all depends on the lender you're working with too, because I know lenders out there today still pricing 7.5%, 7.25% on your 30-year fixed conventional.
And when you look for the CPI, which is the Consumer Price Index, right?
Yeah.
What are you looking at there? Like, what is that a reading on?
Yeah, so it's
people that maybe don't know.
Sure, it's a reading on a bundle of goods. Basically, it's something that is measurable and universal over time. I think it is antiquated. What they look at, doesn't include a few things that are.
Is one of the things like a bushel of apples or like?
Yeah, bushel of apples, number 2 pencils, and so it leaves out a few things like housing, which is obviously a huge expenditure right now. And so I think it's a more of an antiquated model, but it's what we use to determine at this point in time how inflation's going.
Right. And it is how inflation's going, and it's the cost of those varying things. But it's an average, or they add up these different components. And it is like you said, it's not housing.
Correct.
There's things that it is not, and it is a specific set of information from different industries.
Correct. And
to try to get a sense or a feel, but it is for sure a sense or a feel, because sometimes we say, "Oh, the CPI, it got better,"
right?
And then you go to the grocery store and you're like, "What?
Yeah,
it is not better."
Right. Because inflation isn't reversing. Inflation is still happening. It's still growing. It's just growing at a lesser amount. And like you said, it's a 12-month rolling average. So one of these, we can kind of feel where it's going to be going in the future by looking at the cost of those goods and services that are analyzed in the CPI. What were they 12 months ago? How much is that going to affect the next month that's being incorporated into it? How much is that going to affect the interest or the CPI reading? So you can kind of predict it, but you don't know exactly. Right.
Yeah.
But what we've been seeing is definitely a slowing down of inflation, but it's not a deflationary situation. We're not going to see prices go down. And that's the unfortunate part about it that I actually admittedly learned this year, is that it's not like eggs are going to go back to $6.
Yeah, it's
because inflation stays unless we're in a deflationary economy. That's the only time we're going to get back to what we're used to. So this is kind of the new norm moving forward. And there's a ton of different things that affect that. I know that there's been a lot of speculation on, corporate margins. They said it was increasing costs. But is it really? Are they just trying to pad their profit margins?
They would never do that.
Never. No, these are stand-up
And we're not
people.
going to talk about inflation the whole time, but
Sure.
I want to add one more thing, which is the interesting concept that inflation, which is traditionally like a long-term comparative thing. We always think about like what was a hamburger cost in 1950, like whatever, right? Inflation changes. We understand that. But at the same time, with technology moving so fast, right now, the cost to produce something is not what it used to be 10 years ago. So, you just take a flat screen TV, for example.
Right.
I mean, a 72-inch flat screen TV 10 years ago was probably what?
Well,
$8 grand, $9 grand or something.
So I don't know. I don't know if that is particularly a great example, because from what I understand, TVs especially, they actually subsidize the production of the physical TV by having in the agreement that they're going to sell your data. So like it's actually part of it is subsidized by them farming kind of, and there's like little things, and getting back to kind of the technological aspect of that, it makes things so much easier to do nowadays. I mean, yeah, TVs are, you could buy 6 new TVs. It's so funny. My parents just got a new place, and they were like, "Hey, we need some new TVs while we're waiting to like get all the actual stuff. Like we're gonna buy new TVs, but we need some new TVs just to have in there." And my uncle's like, "Yeah, I got a TV, and it's from like 2003, and it is this big, and the screen is this big." Yeah, and it's like the advancement is. Sometimes it outstrips your how much you like. I don't want to buy a TV, but I also want a TV I can actually see on the wall. You know, it's just there's so many different factors that kind of go into that. But I recently learned about kind of farming information and that sort of stuff. But yeah, it's definitely
the data part is there for sure. But
yeah,
and to the consumers, like, you know, on the forefront. And actually, this is going to play into some of our conversations about like the settlement statement in real estate and who pays what and how those things get kind of washed into the purchase price of a home. But to the TV thing, it's just like, 4th of July sales last week were like, I can get that TV for like $300 now. And it was $3,000 a year ago. But not a year, but like 10 years ago.
Yeah, and that is, I think, the definition of technology is making things more efficiently and more cost effective over time.
Which is why I threw out the bushel of apples. Exactly. Because it's like it is kind of an antiquated. It could be construed that way, where it's like it feels like things are still going up price wise, but there are certain areas and components that are not considered in how they pull that out. So, but the CPI goes down a little bit. It says inflation's coming back. We have a lot of monetary policies in place to do that. Inflation rate, or not, but interest rate set higher and increase is meant to drive down that and to just slow things down in general. And so that's what you were saying, is that CPI has affected the rate a little bit, and we're looking like we're going to get a little better.
Yes, that's correct. I mean, what the Fed is looking at, they've been very vocal about it, and anybody listening and watching the Fed can understand they're looking, it's a two-prong approach, right? They're looking at CPI, is inflation going down? And they will not touch rates unless CPI goes down and unemployment goes up. So we know those are the two leading indicators on the Fed's rate policy. And if inflation's going down and unemployment's going up, now we're going to see rates coming down. And that's what we're seeing now, is that the markets, which are basically purely speculation, right? It's not necessarily true value of a company you're buying a stock. It's the speculation of the future value. And it's the same thing with the way that rates are going to move. The market's already pricing in 100% guarantee drop in rates in September. So now we're seeing interest rates coming down because they're expecting the Fed to come out and announce a reduction of rates in September.
Right. So if we do it properly, we may not actually see a rate reduction in September because they're already baking that into the cake now.
Well, yeah. So
I mean, we will, but I'm just saying, like, they're anticipating it, so they're prepping for it by starting that process earlier.
Well, a common misunderstanding is that the Fed's rate that they're dropping is directly mortgage rates.
Correct. Yeah.
Yeah. It's actually not directly affiliated, right? Interest rates are based off of the bank's opportunity to operate and collect profit. So if they know that inflation's high, they have to have a high interest rate in order for them to still make money. right? Because they're now dealing with an more expensive business world and more expenses, higher rates for them to even borrow between banks, the higher cost of doing business. So that's just their analysis and their actuarials predicting like, this is what we need to offer our rates at if we're here in inflation. So when the Fed drops a rate, they're dropping actually the federal funds rate, which is the rate that is used and calculated when banks borrow from each other.
Right.
And so inversely, it will affect mortgage rates because as a sign of inflation going down, they can reduce their interest rates.
So from the interest rate and the market going on right now, what else is, I've heard some things about some people think that there is a housing bubble or that there's something going on in housing. I think the headline I saw was like 44% of consumers feel like, maybe feel is the operative word, but they think or feel that there's something going on in the housing market. What are you seeing from your perspective?
I can understand where their feelings come from because it's almost shocking, getting into the mortgage industry in 2008 and seeing where the top of the values were, the dramatic drop, and now we're above where they used to be. You got to think something's got to give here, right? Because those values were inflated. So are these values inflated? But so I can see where their sentiment is coming from, but it's actually, in my eyes, and of course I don't have a crystal ball. If I did, I'd be a millionaire and
I'd be over there.
Wouldn't be here. No, I'd be here. We'd be hanging out still. But it all comes back to supply and demand, right? Right now, we're in a huge shortage of inventory, but that's just generally speaking. You can see some markets are actually starting to see significant depreciation. Those are the markets that have been overbuilt and there's too much inventory. And that's not necessarily specific for Phoenix. Phoenix is growing at an exponential rate and we do not have enough housing. I think nationally we're about 2.2 million units short of a normal market. So, and on top of that, the builder sentiment has just been decreasing over the past several months. So now you have a shortage where builders are not very confident that they should build and make up that difference. The reason 2008 happened was because we were oversupplied. We had too many units out there and not enough demand. Now we're in a complete reverse of that where there's not enough of it.
Yeah.
So now we're in that just simple supply and demand situation. And then, speaking locally here in Phoenix, Scottsdale area, because of COVID, I think we've been basically put on a pedestal as one of the best places to live. Sunny every single day. I never have to check the weather app. I know it's going to be sunny. Entertainment. Ton of different entertainment's always coming into town. Events, we're like the convention, we're the city built for a convention. All these different huge attractions like Super Bowl, NCAA stuff. Obviously we've got the greatest show on grass with the Waste Management Open just growing exponentially every year too. So now we see just a demand for this real estate in several different facets. And then you add in, some of these investment firms trying to buy single family residences to get into that rental market too. So it's like there's a lot of demand coming from a lot of different sectors.
And I do think to kind of add on to that, one of our key contributors is the difference between Arizona and California in terms of pricing, housing prices. I love looking at those videos and those reels that are like what you can buy in Arizona and what that same price would be in California. Yeah. And it's like, you can't believe that. It's just still, quite affordable here, even though it's less affordable than it was like a couple of years ago with inflation and all that stuff, but it is relative to the general market, and especially the region.
Yeah.
Arizona's still pretty good about that.
Yeah. Just simply take a look at property taxes. We are some of the cheapest property taxes out there. California has huge taxes, Melrose to pay for all the new development going on. And then you have states like Texas, but that offsets their no income tax, but you're looking at $15,000, $20,000 of property taxes every year, which is just maybe a little bit harder to come up with than say paying an income tax. But yeah.
One of the other things I'd just throw in that I kind of agree with you. I don't really see anything in the market that is alarming to me. And if you go back to like 2008 era, you just think about how leveraged properties were. And relative to now, I don't have the exact number, but the number of people that have bought homes for cash in the last 10 years here in Arizona is really It's kind of mind blowing. They sold the property somewhere else. They cashed out there and they brought that here. So the general market here for housing is not as leveraged as it was in 2008. I mean, just crazy. To think about when I was doing loans back in 2005, 2006, there were actually loans at 107% LTV.
Oh, yeah. Yeah, 80-10-10s. I mean, all financed. Yeah, it was crazy. What I saw in the file cabinets of some of the B of A offices that we took over and went in, there were some old loan files in there, and I went in there and read it. I mean, it was crazy loan to value ratios and done all based off a 620 FICO score with no income, no assets in the file, And so, yeah, comparatively to now where, there are strict lending requirements in place, DTI
and the underlying fundamental is really strong.
Yeah.
And the fact that all the interest rates that are out there right now, the people who currently own, there's literally no incentive for them to sell.
Yeah.
It's very difficult to sell a house and go buy or like move up. That we've talked about that in other episodes where it's like that whole process of buying like a starter home and then like 5 years later buying something else, that's been put on hold because of the interest rates and where they're at. I mean, just the price to do that is kind of outrageous.
Yeah, the math doesn't math. To sell your house, get those proceeds and put them into another house, the payment is so much higher because of that higher rate, the elevated rate, that it doesn't make sense. You're contributing a too large of a portion of your income. It's not going to be comfortable to live anymore.
Yeah.
You're going to be house rich, cash poor.
One of the factors that it was true back in 2007, 2006, leading up to that I'm starting to see now, and I do think has to be reconciled, is this idea that to rent a place is right now cheaper typically than to buy it. And I'm not sure how that either the rents have to go up or like we're talking about rates will come down to incentivize those and kind of bring those back to an equilibrium, which I think is probably the more probable case. But right now, if you were to go buy a condo in Scottsdale, it may cost you more than it would to actually rent that same condo.
Yeah.
And you don't have the overhead of fixing things if something breaks, if the water heater goes, or if something else happens. You don't have that extra expense. Yeah. So it's the interesting part of the equation that I do think has to be reconciled at some point.
Yeah, I agree. I mean, I don't know how it's possible, but every single apartment complex that I see being built is a luxury apartment complex, and they're charging these exorbitant amounts. And how that's still cheaper than buying is, it's a shame. But I think now, because of the interest rate movement, we're going to see that dramatically shift to be much more cost effective to go ahead and buy right now.
So I did see a stat the other day, and it was, if the trend from the previous 40 years holds true, and they're talking about relative to inflation and cost of goods and cost of homes and so forth, they said in 40 years from now, the average median home price would be $5.6 million. So think about that for a second.
Yeah, chew on that.
So you're hemming and hawing over buying a $500,000 house now, but 40 years, and look, it's hard to think 40 years down the road, right?
Yeah.
But you just hear all the stories. But back in my day, I only paid this much. It was like
$50,000. My rate was 14.
I saw production home pamphlet for who was John F. Long in town. And one of our clients was the daughter of one of the architects there. And in her house, when she received it from her parents to pass it down to her, she had these old pamphlets. And they were literally like selling houses in Maryvale, brand new houses that were like $4,500, $5,500 models.
Yeah.
I mean, it's just crazy.
Wow. Yeah, and it's an interesting concept you bring up because we actually did that same exercise in relation to tuition rates. By the time we were old enough to have children that are ready to go to college, if we followed that exponential growth, it'd be $250,000 a semester. We haven't seen that. So we may not see that in real estate either. I think it all kind of falls back to, just the economy in general and the consumer sentiment, obviously, but also the the wage growth. There has to be more wage growth in order to support that standard, that median home price being so high.
But that's also inflation. And that's a component of it. But one of the other factors I was kind of just thinking about is like, that the reasons to actually buy a house. I always tell clients that, can you time the market to buy perfectly? It happens. People buy houses every single day they close. So some of those are going to be at the exact right moment where the interest rate was the lowest, the pricing, everything was just like aligned perfectly. It happens.
Yeah.
But in order to plan for that, I mean, you drive yourself crazy. Yeah. You would just be sitting on the sidelines forever. But when you kind of zoom out to a macro level and you start to think about these big forces and whether something's good now versus good next year, you start to think like, well, it doesn't really matter if it's like this month or next month. We just need to get in the market at, what's good for us.
Yeah.
Like, does it make sense for my lifestyle? Does it make sense for my job right now and my family situation or, what I'm doing? Then yeah, maybe you should go and buy something now. Because 20 years from now, you would probably be looking back on and say, hey, I should have done that.
Yeah.
And it wouldn't have mattered if it was, the fall of 2024 or the spring of 2025. That would be somewhat negligible.
Yeah. No, you're absolutely right. And it's funny when you analyze what, like, say, 2020 was like in 2021, where you were overbidding by $50,000, $100,000 to get into a house, paying so much more than the appraisal came back at, and nobody really blinked an eye, right? Everybody's like, I'm going to do it. I'm going to do it. This makes sense. But then that's their affordability, their liquidity that they're negotiating there. But now we have high interest rates and everybody peels back.
That's like one of my favorite, like, anti-logic, like,
right.
Like, what's going on here? Like, I will pay $25,000 cash today, light it on fire and burn it. But I won't pay $300 more per month.
Yeah. If you analyze what that increase in their mortgage payment has been from taking, say, 5.5 to 7.5, annualize that over like 2 years, you're nowhere near that $100,000 you just overpaid or put in.
It does, in fairness, it does come down to sentiment, like where you think the market's going and how the market is trending. And it does have a component there. But like I said, when you kind of zoom out and you look at the two things comparatively, you're like $25,000 cash today versus a $500 extra payment per month. Like, how long would it take you at $500 a month to catch up to that 20? It would take you 5 years almost, right? So,
and no, but you're right, because it goes back to sentiment, right? Because so the rates go up and everybody thinks, okay, this is the thing. The other shoe's about to drop. Now we're going to see a decrease in prices, but we didn't see it because we don't have enough houses. So that demand has still been there. And the unfortunate part is that people aren't educating their buyers enough to understand that just because there's a 7.5% par rate doesn't mean that's the rate you're going to have to pay. If you look at temporary buy downs, 2-1 buy downs, things like that can create that affordability on the expense of the seller to make it more livable. I mean, that's the biggest opportunity that I've seen in the market, is to educate people about how to create affordability and not overpay for an asset right now. Because like you said, you can't time the market. You just simply can't. Get in the market. If you're not already in it, get in it, because it's one of the best investments you can make in your life. Right. And that's what it's all about. I mean, that's, one of the things that I've enjoyed in my career is helping people create wealth. And that's what we're trying to do here. And that's the best vehicle to do that.
And when you look at it comparatively to other types of investments, you may come up with a different answer. But to your point, why is it great? I always think that it's great because it aligns with your expenses anyway, right? So if it aligns with things that you have to pay for, which is housing or renting or whatever, and you can deflect some of those costs back into appreciation on the asset and buying down your principal monthly, like those things start to make sense. And I think that's the component that makes it kind of a great decision. Yeah. So I do want to transition into kind of one of the hot topics on like the NAR lawsuit and kind of how it looks from the mortgage perspective. We've talked in the past about what we're anticipating on the real estate side from a brokerage, from an agent and transactional thing, which for just to kind of put it out there is the biggest effect is that the commissions are not going to be listed in the MLS as paid to the buyer's agent starting in 2 weeks, basically. So what that looks like is a contract, a buyer broker agreement, which, as you know, many agents don't do. What do agents typically want to do is they want to get a client, and the easiest path to consummating that relationship or doing that is the path of least resistance is not to have them sign so many papers. Mm-hmm. And to address the cost of what your service actually costs is hard to do sometimes.
Yeah.
So whether you decide to charge 1% or 2% or 3% to your buyer is, and has always been, like we talked about before, that's always been, on the table to do. It's just a lot of buyers didn't know about it or didn't care about it, or because it was being paid for by the seller.
Right.
So now there's an extra cost for the buyer as they go into it. And one of the things in my mortgage background, and I think you can talk about, is like, what can the seller pay for a buyer on behalf of the buyer? So you've got closing costs, and now you've got this new thing,
right,
which is the commission to their agent.
Correct. Yeah. And so kind of going back a little bit and to, harp on just why it's happening, right? It's because we weren't being transparent enough through this whole transaction. Like you were saying, people, instead of signing a buyer broker agreement, agreeing how you should be paid, they're trying to tell their buyer, hey, don't worry about my commission. The seller's paying it. So now what we're doing is providing more clarity and being more transparent during the whole transaction. If like, this is what my cost is, and now unfortunately somebody's gonna have to pay it. Either it's going to be you or the seller. But kind of going back to your question specifically, what we look at in the lending world is what's called IPC, interested party contributions, which they vary. The limits, the allowables vary depending on the type of loan that you're doing. So it's kind of complex. Conventional will allow a certain percent, like 3% only coming back from the seller toward their buyer's closing costs. With a low down payment scenario, allows for greater contribution from the seller if they put more money down. FHA is different, VA is different, but the best thing that we know now is that all of those institutions, Fannie, Freddie, VA, FHA, they've all come out and said that any money that that they're contributing toward the buyer broker, so the commissions on the buyer's agent behalf, is not considered an IPC, an interested party contribution. So we don't have to look at, okay, we're limited to 3% interested party contributions. Only the buyer's broker is going to get 1.5. So now the buyer themselves is only left with 1.5.
Right.
That's been thrown out the window. So now.
So, and then let's just touch a little bit on the IPC, interested party contribution. So that is basically the seller contributing to the buyer to incentivize them to buy their house. And one of the reasons that they limited that is so that we don't have crazy appraisals, right? Because if you had a house for $500,000, but the seller was going to pay 10% to incentivize a buyer, then that $500,000 appraisal is not really a $500,000 value.
Right.
Because if you were to buy it for cash, theoretically the seller would take 10% less.
Right.
So having those regulations or that stipulation in the underwriting guidelines for an IPC limit really helps level the playing for how they compare apples to apples when they're doing, how much a home is worth in the appraisal process.
Right.
And from my perspective, part of the seller cost has been the buyer's agent's commission. And so when we take that piece out of the value of the property or the appraisal process, it still has to be included somewhere in it. What it sounds like you're saying is like the underwriting guidelines will allow that.
Correct. Yeah. They're just going to say that's separate.
Yeah.
That's not dealing with the borrower.
Do they have a cap on that?
In terms of what the buyer commission can be?
Yeah.
No. I mean, that's, and that's kind of what people need to understand too about this NAR settlement, is that they're not saying 6% commissions is over with. They're not telling you have a cap on how much you can charge. If you have a buyer broker agreement that you are providing so much value, they're going to pay you 10% commissions on it. That's allowed.
Yeah.
They don't have a cap on it. So that portion is going to be left out of the mortgage process, thank goodness. And we can just kind of do business as normal, business as usual.
Do you think that some of the agents that are going to have a hard time with that buyer broker agreement?
Absolutely. Like you just kind of referenced and I touched on, is like the whole old way of doing things has been uplifted or upheaved. People used to actually tell their buyers, don't worry, the seller's paying me.
Yeah.
You're not paying me. Well, wait a minute. There is a cost of your service. And to say that you're doing it for free is not an accurate depiction, because you are taking a fee, and that is actually being paid for by the buyer in the sense that he's paying an inflated amount to cover your commissions, right? So I think there's going to be a very big learning curve for folks that haven't been using a buyer broker agreement. I mean, I know that successful brokers out there have been using it for many, many years, because it really simplifies the transaction, and it provides the education up front that, look, we're going into an agreement where I'm getting paid for a service that I'm providing, and how much am I getting paid, and it's all up front, and that makes the rest of the process easier. Now the buyer feels much more confident about understanding the process. There was a stat that said there was 3,000 home buyers surveyed. 97% of them couldn't illustrate how people were paid out, the structure, the economics of the transaction, who pays who. They have no idea. They completed a purchase. They have no idea how the economics worked. How did my mortgage broker get paid? How did my buyer broker get paid? So that's really what's going to be great about this, I think.
And when you don't understand the economics of it, then you also don't or cannot place the value. You don't understand what value you received for all of that.
Right.
Which is, to your point, experienced people who can explain their value and have their own self-worth and have a value for their service are going to be fine, because they're going to be able to explain that. And the people that were going to struggle are people who are kind of coming into that new or are uncomfortable explaining to somebody what they're bringing.
Yeah. And it's really challenging too, just because it's a low inventory environment. So we might be having people that are willing to take less money to represent a buyer. Yeah. So but hopefully, people understand the true value and can express that to their buyers.
All right. Well, that sounds great, Zeno. I appreciate you coming on. It was awesome talking with you today. Both to get to know you a little bit more and your background and how you got into mortgage lending, and also a little bit of this information about the current market. Look forward to having you again sometime in the future.
Yeah, thank you very much. It was a great experience. Thank you very much, Ted. Jason, this was great. Great talking with you. Look forward to the next one.
All right. We'll talk to you next time.
All right.
We'll see you guys later. Thank you for listening to the Axis Real Estate Podcast. Please like and subscribe on YouTube. Just search for the Axis Real Estate Podcast. If you'd like to get in contact with the show, please email mail@axispropertyadvisors.com. You can visit Axis Real Estate online at axisre.com. This podcast was produced by T-Door Productions. Theme song by Delicate Steve.